A lot of questions for today because you guys are usually very brief when you talk and never really want to drone on. But given today, and we're all being liberated.
The right people here?
Yeah.
Where are you?
I just figured what I was going to do is do this, and who cares? Let's talk about Liberation Day.
Yeah.
And why don't we start with, kind of the policies, what we see today. And Jeffrey, let me start with you too. Obviously we're all trying to digest the information. It's one thing about the president, he never shows up on time. We had to wait for him, but we're getting some of this news in now. So what are you sensing about this? And, kind of, we think there's a long game here, right? In the whole tariffs policy?
I think it's just part of a process, really.
Yeah.
He keeps talking about reciprocal trades. I don't know if he thinks he's accomplished that in an aggregated basis. 'Cause I guess what he's sort of trying to do is get the trade imbalances down. We've got, what is it with Mexico, 130 billion? Canada's 60 billion, I think it is. Mm-hmm. And, our trade balance broadly is pretty bad. And, we worry, there's a lot of debate about what the consequences of these tariffs are going to be. But if you look at the action of the market in the past 20 minutes, it's clear that there is no consensus whatsoever. I mean, the stock market went up massively, then dropped and went back up, and now it's basically on the low of this whole tariff thing. The bond market, though, seems to be relieved to a certain extent because yields are back down to 4.11 on the 10-year, which is pretty low versus where we were a few weeks ago. And the only thing I can take away from that is they're a little bit relieved that there won't be potentially a greater inflationary impact. That's what it looks like to me, but we'll see. I mean, he's still talking. And it'll probably go on for another 45 minutes at least.
Well, I mean, if you think about it too, you saying that phrase, Jim, it reminded me of Mr. Powell at his press conference the other day and using the T word again and talking about inflation being transitory. And it probably is, but you have to deal with the whole price level action, right? And so this is part of the problem that's been the psyche of just, I would say, the American populace in general, right? And, how do you think about the tariff policy, what it does? Yes, it's nice to have a trade balance, but how do you explain it to the constituency? That we have to do this in order to balance something like trade.
That's an interesting question. I think, if you take what Trump is attempting to do by balancing trade, is he would argue that since the U.S. went into WTO around 2000, that you've seen a hollowing out of heavy industry, manufacturing, construction, and a lot of jobs that go with that. And to put some numbers on this, about 35% of the American public has a college degree, 65% doesn't. And if you're part of the 65% that doesn't have a college degree, where do you get a high-paying job? It's usually in heavy manufacturing or industrial or construction and the like. And those jobs have been shipped overseas. So Trump's argument has been, I'm going to try and help you get jobs back by trying to rebalance the world so that it is profitable to make those products here in the United States. I get the sentiment. I understand that, I'm pro-globalization, but let's be real. There's been a cost, and that cost has been borne by people at the bottom 50% of the income spectrum, that a lot of their jobs have been shipped overseas and that they've been disproportionately bearing that brunt. And Trump is the first guy that's come along and said, I hear you, and I'm going to try and fix it. Now, we could debate whether or not he's doing it the right way, but he's not giving the Obama, you can't wave a wand and make those jobs come back. Or he's not doing the condescending Biden thing, go learn the code. Don't bother me, go learn the code. And those jobs aren't going to come. Those jobs are going away anyway because of AI.
I think it was Mitt Romney, actually.
Was it Romney that said learn the code?
I think it was learn the code. I think Biden was learning to make solar panels.
Yeah, so I think that's what he's attempting to do. Now the markets, I think, are struggling as to what does this mean? Is it inflationary? And January it was, yes, it's inflationary, and tariffs means a strong dollar. But now we're in April, tariffs mean recession and a weak dollar. So just like the market's kind of zigzagged all over the place in the last.
But isn't that just a yield story at the end of the day? Because since we are one of the higher yielding currencies here in the U.S., isn't a lot of that performance of the dollar really just yield differentials more than it is actual
It really
policy?
has been. If you overlay the Dixie index, which is heavily euro, but other more trade-weighted indices show similar pattern. If you overlay that on the 10-year Treasury yield for the past, I'd say 2-3 at least years, maybe 4, it's the same chart. I mean, I didn't bother to run R squared on it, but it's a very similar chart. And, you know, it's interesting how since the Fed started cutting interest rates, we've had the dollar vacillate around, but it hasn't moved an awful lot. And 10-year Treasury yields are actually up since by less than they were 3-4 weeks ago, but they're still up. This is the first time in history that in the wake of the first Fed cut that the 10-year Treasury yield actually rose. And the 2-year Treasury yield also rose, which is kind of amazing. I think the Fed only started cutting interest rates because they were so extremely out of line with where investors were pricing Treasury bonds. I mean, there was one of the biggest gaps between the 2-year Treasury and the Fed funds, but from the 10-year Treasury to Fed funds, which a lot of people don't follow that closely, it was basically the biggest gap in like decades, if not ever.
Yeah.
Right.
And so they were completely out of whack and had to come back in. But one thing about the tariffs, if the problem is that we have a trade deficit with all these other countries, well, it's because they're cheaper. And if disinflation was a trend for many, many years, with all of those jobs going overseas and that trade balance ever expanding, it seems that you should at least entertain the idea that going the other way, bringing the jobs back, will not be disinflationary.
In fact, you know, Lloyd Blankfein, the former chairman of Goldman Sachs, was in an op-ed in the Wall Street Journal like 2 weeks ago. And he said, yeah, you know what? And this was before the announcement of the auto tariffs. Yeah, they're going to raise the price of a car a couple $1,000s. But if that brings back hundreds of thousands of jobs where a single earner can raise a family again, an auto job, it might be worth it. And so there's that kind of thinking out there.
Yeah.
You know, so I guess we're back to, if you're part of the 65% that doesn't have a college degree, and you can't go into an intellectual property job, if you want to define it broadly, we're all in the intellectual property business to some degree or another. What is their opportunity? And just don't tell them to go back to college, because obviously that's not going to be a viable alternative. So Trump, like I said, he's proposing an idea, and we could argue he doesn't have the right idea, but he has maybe the right sentiment, that this is a crowd that has been neglected, and now he's trying to focus on them.
So, but on that side, if we think about the pain that was inflicted by inflation, right? We being, you know, a part of the IP class, we would call that a regressive tax.
Right.
Aren't tariffs extremely regressive as well?
Yes. I mean, I would argue that they are. And this is the dilemma that we face. And this gets to kind of the bigger issue. You know, I wish I brought my copy of Art of the Deal, right? Are tariffs a source of revenue, or are they leverage? And I've been of the opinion that they're leverage.
Yeah,
and that Trump is looking to use those to get something. And you're starting to see some fruition of that leverage. Israel has said that they're going to go free trade, zero tariffs. Mexico has made some noise about trying to, put a tariff on China. Quick word about Mexico, because when we talk about, who our biggest trading partner is, it is Mexico. And after NAFTA and USMCA, we had a $15 billion trade deficit with Mexico. Now it's like 130, 140. How did that happen? Well, China, getting around all of the tariffs we put, they send parts to Mexico. Then in Mexico, they assemble it, a computer, a car, whatever it happens to be, and then they ship it up here without a tariff. So they're doing a regulatory arbitrage is what they're doing. Well, that's fair game for the president to attack that, as opposed to putting global tariffs on everybody. Because remember, our three biggest trading partners, which is almost 2/3 of our trade, is in order: Mexico, Canada, and China. fourth place, in a distant fourth place, is Germany at this point. So if you want to talk about trying to regulatory arbitrage around a lot of the rules like China is doing. So when he leans on Mexico, they've already said, look, we'll put a 10% tariff on stuff from China to Mexico if you back off of us. So he's starting to get that kind of give. And that's why I think ultimately these tariffs are art of the deal. They're leveraged. They're not necessarily going to be permanent. Now, last thought is you might say, yeah, but he says they're going to be permanent. He says they're going to finance the deficit forever and ever. But that's part of art of the deal, right? You got to make them think you're serious in order to get the leverage that you want.
Well, I mean, and Jeffrey, would you think in your lifetime you would see the German government pledge €500 billion to defense spending? You know, the ideas we've seen in the Eurozone, the amount of fiscal stimulus coming outside, where, you know, this was an area that was priding themselves on austerity. So do you think this, and not that they were austere, right, but they were talking about it and pretending to be where we haven't done so. Do you think that changes the balance of things as well?
I think the balance with Western Europe has been changing more rapidly, but it's not just because of tariffs, it's because of the Ukraine situation and our insistence that they start to put in their so-called fair share, if you will, their 2%, and maybe go higher with that. And I think we've gotten to a place where some of these countries are worried that the U.S. is going to be more inward-looking, isolationist, ultimately, and they're going to have to pay for it themselves, which means they're going to have to reindustrialize.
Right.
And this is one of the main reasons, I believe, why, for the first time in a long time, that for real, the European market, equity market, is outperforming the U.S. market. I mean, for real. It's had weeks, it's had months, it's had quarters, but this is for real. The European market is up like 12%, just broadly, and the MSCI Europe and the S&P 500 is down 12%. So, or I don't think it's down 12%. I think it's down
that's
9.
High.
That's down 9. Yeah. But anyway, it's a gap that's like 15 points. Some days it's as much as 20 points. I believe the outperformance of the U.S. market is now in the rearview mirror. It's been such a long trend. And one of my favorite charts is just looking at U.S. S&P 500 versus world index, except for the U.S., so everything else but the world. And it has gone through some very broad swings going back to the Nifty 50 days of the early 1970s. And it was thought to be, I lived through the Nifty 50 as a kid, and the stocks just were getting taken to the woodshed every single day. And in hindsight, people said this was a bubble, this was nuts, this Nifty 50 thing. And so it ended up being that the rest of the world outperformed, and then it got down to a very low level. And then the dot-coms, we got right back up to that same Nifty 50 type of outperformance of U.S. of S&P 500 versus non-U.S. And if you look at that chart now, since it bottomed out back in about 2010, it is so much higher than it was in the early 1970s and in the pre-dot-com. I mean, by a mile. And yet, you have to ask yourself, why is that? Yeah, I mean, is it that we're a morally superior people? I don't think so. You know, I think it's because we have had a massive flow there's all these imbalances. What we talk about, the trade deficit. There's the foreign net investment position in the United States has expanded to a huge number. Back about 2016 or so, it was about $2 trillion was the net foreign investment position U.S. So they had $2 trillion more invested in the U.S. than we had invested overseas. It's now something like $27 trillion. And it's gone up by trillions and trillions of dollars in just the last few years. And it's been strictly monotonic in the way it's done. It just always keeps going. And I think that could reverse. And if that reverses, then the rest of the world will very likely outperform the U.S. because if money is repatriated back to those other countries, forget about all 25 trillion getting repatriated. How about 15 trillion?
Right.
I mean, 15 trillion is a massive amount of market cap. And so I think for real, you're supposed to be diversifying outside the United States. I actually talked about this on our Roundtable Prime as one of my primary ideas. And for once, I was almost immediately right. You know, usually you're right 8 years in advance, which in the investment business means you're wrong.
You know, you did have the bell was rung for you, though, because 2 weeks after the Roundtable Prime, they had the World Economic Forum in Davos. And one of the big themes that came out of Davos was Europe is terminal. It's never going to go up again.
Also, don't forget Trump.
Days later.
Also, don't forget Trump rang the bell at the stock exchange at the high as well. They say you never ring a bell at the top.
It's amazing how well that works. It shouldn't work as well as it does.
It does.
Just like I get the New York Times only to do the Friday Saturday crossword puzzle and the Sunday magazine puzzles, but I get it every day. And it's funny. I saved the October. Was it 2023 was the high-end rates? I think it was October 2023. And I looked at the paper on the front page of the business section, and I had one of those moments because it has in fairly large print. It says, homeowners starting to process that rates will never come down. And lo and behold, that was the day of the high on the Treasury yields.
Well, the simple contrarian theory says that that's the way it's supposed to work, right? Because whenever the crowd feels strong enough to say it's hopeless, Europe will never go up again, is because every single person in the room is short the market. And you've run out of people to show either underweight or short the market because they're all in that trade. And now we're just waiting for it to turn. But the other thing to keep in mind, too, is that the valuations are very compelling because Europe, let's go back to the beginning of the year, was like a forward 10 PE on like the Euro Stock 600, where the S&P was like 22. So, but you know, the argument then was it was cheap for a reason.
Sure.
But now that that reason is gone, it's still, even after the rally, a fairly cheap market. Can I make a quick comment about your Nifty 50 thing? Because I've looked at the Nifty 50, and keep in mind that when these big broad themes, think Mag 7 when I say this, when these big broad themes peak, two things happen. The reality of what those companies are trying to do gets realized, and the stock prices never go up again. So the two examples I'll give you is in the 1920s, RCA was the hot stock, Radio Corporation of America. Everybody's going to get a radio. It peaked in 29. It wasn't until the mid-1960s that RCA, 40 years later, took out its 1929 high. Not only did everybody get a radio, everybody got a black and white television, and half the country was on their way to getting a color television before that stock finally peaked. In the 1973 4 Nifty 50 peak, companies like ITT and Xerox, Kodak, never made their all-time highs again. Before they either, in the case of Kodak, went out of business with bankruptcy or got acquired by somebody else. But what they were promising you with Xerox making everybody's going to have a copy machine in their office, that happened. It's just the stock never made a new high because the market's forward looking and it's priced in the whole generation. So when I look at the Mag 7 companies and people say to me, man, these data centers and AI is going to be as big as the internet, I go, you're right, it is. But that doesn't mean that those stocks necessarily are going to keep going up because they might have already priced in the coming generational change because of AI. That's what we have to be careful of.
Another mega trend is market capitalization weighted things like the S&P 500 have greatly outperformed equal weighted indices. If you just look at the equal weighted S&P versus the market cap weighted official S&P, that is also gone, has had these monumental swings. And that is not as convincing as the US, non-US trend break, but it's there to be seen. You know, you talk about things being discounted. Back in around 1900, people started to realize that electricity was going to change the world, and
it did.
And it did.
Yeah,
it totally did. Obviously, I mean, just look at AI, which is electricity. But the outperformance of electricity stocks versus the broad U.S. stock market hit its peak in 1911. In 1911, the electricity revolution was just barely getting started in 1911, but it was all completely discounted versus the rest of the S&P. And I know that story about RCA because there was this guy named DeVoe, Ray DeVoe. He used to write a market letter, and he used to tell this anecdote that when he started first years in the business in the 50s, this doddering old guy came wandering in, and he said, "Can I help you?" And he said, "Sonny boy, I'm here to sell my Radio Corporation of America stock." And he says, "Well, all right. Well, when did you buy it?" And he said, 1928. And he said, "So why are you selling it?" And he said, "I'm back to cost."
In nominal terms, even, right?
30 years later.
It's funny you say that because
The reason markets discount this stuff is maybe stock traders are smart. They saw what was happening. They saw what the potential was of electricity in 1911, and they priced the whole thing in for the next century at that point. And that's what you have to be careful of with companies like AI and stuff like that.
Well, it also affects
Divorce the price action of the stock with the promise of the product. You know, they're not the same thing.
it also causes herding behavior a lot. You know, when you have 7 stocks that become a historically outsized driver of the S&P 500's return, there becomes an ever-growing fondness for indexing, because as that sector has its very strong performance, the index outperforms most active managers. Most active managers, other than like the ARK fund or something, don't want to have 45% in the most go on the moon speculative stocks. But so they go in the index fund, but that just makes they buy those stocks that next day. They buy them, and it keeps the party going until such time as it reverses.
Right.
And then that momentum works on the downside, and that's exactly what we're seeing.
Can I ask you, we go back to Europe, you talked about the European stocks. What about European bonds? They're going straight up, and the spread between the U.S. and Europe is collapsing.
Yeah, that's why I believe that in the next recession, the dollar will be counter trend to what we've seen through the course of our careers in their entirety. The dollar will go down. I think that's going to happen. I think that differential, I think the long treasury rates are going to go up in the next recession. I mean, we started out talking about the tariffs and the heart's in the right place, and you're trying to balance things out, and you have this issue with the hollowing out of a large fraction of the population. So it's good to do something. It's not a coincidence that that's happening in contemporaneously with we've got to do something about this interest expense. We can't keep going up $1 trillion a year in interest expense. We're pushing $4 billion a day in Treasury interest expense. It was $300 billion a couple of years ago. So the trajectory is right. Do you know
is this why you think Besant and Trump are talking about targeting the 10-year now? Like they want it down? Do you think that's part of it?
I think it's going to go beyond targeting, because I don't think targeting is going to get enough. We already got a little taste that didn't get a lot of play, but I spent a lot of I looked at it carefully, because I started talking about this about a year ago, and that is that what if we decide that one way to kick this can down the road even further is to maybe restructure some treasury bonds. And I saw that it came, I think Scott Besant even maybe alluded to this a little bit, that maybe we will take the foreigners that own our bonds and extend their maturities out probably to infinity,
right,
and cut the interest rate. And I actually talked about this about a year ago, and actually acted on it in some of the funds where we thought it was the most relevant.
And the Mar-a-Lago Accord is what.
Yeah, the Mar-a-Lago Accord. Yeah.
Yeah.
And it's just because the average interest expense on treasuries used to be around 3%, and it's up to about 4% because rates rose. But if you cut it down to 1%, just by executive order or something, that would reduce 75% of at least that fraction of the treasury debt. Now, of course, this would be met with outrage and a lot of anger, and they'd probably say, "We're never buying your bonds again." We would say, "Well, this is just a one-timer," which, of course, Argentina it never is.
The nuance on that, and to bring it into more recent news with us attacking the Houthis to try and reopen Red Sea shipping, is even the New York Times is admitting that the Houthis in Yemen have too much technology for Europe to do anything about it. The only military that can open the Red Sea is the United States Navy and our Air Force. So the argument has been, you guys in Europe have had a free ride for generations by not paying for security. You pay 1 or 2% of your budgets in defense. We've been paying 5 to 8 until the Soviet Union fell. I've actually looked it up, did a piece on this last week, that since 1960, the U.S. has spent $23 trillion on defense, which is 2/3 of our debt outstanding, although there's other things in there too. And Europe has spent 7 over the same period. And who's on the front line is Europe. So the argument has been, you got to start paying for this stuff. And the way you're going to, well, obviously, or you got to pay us in order to be your security. Well, you're not going to write me a check, the big Vista print 2-foot check for $3 trillion. So it's the bond swap. Is you're going to take all your treasuries and you're going to give them to us, and we're going to give you a 100-year zero coupon bond. That's just the form of payment, but it's back to
same thing.
It's security. So.
And Jim, you're going to say thank you for that too.
Right, exactly. So when you say it's a one-time deal, we'll never do it again, Trump's response would be, no, you're going to do that so we continue to support you security-wise, because he got in hot water during the debate. I mean, not during the debate, during the campaign, when he said, if Europe doesn't pay, I say to Russia, do whatever the hell you want. So, basically, if you don't pay us, then Vlad, roll right in, because they can't even stop the Houthis. You think they can, depending on what you think of the Russian military, they can't stop them either.
So we got a protection scheme running
right.
geopolitically, and we got a Ponzi scheme running
right.
the social network.
All right, so that brings me to a very
that's Trump to Europe. It's a nice place you have. It'd be a shame if something happened to it, right?
Yeah. Well, I mean, we're moving into Greenland soon anyway. So, but a question on all this is that as you kind of put that juxtaposition against each other, Jeffrey, I keep hearing this, or I'm reading this word stagflation, and I want to bring up the whole quote. I don't think you know what that means when people are saying it. How do you think?
It's pride. Right?
Yeah, there you go. Right. Yeah.
That word you keep saying.
You keep saying it. I don't think you know what that means. Right. Very good, Jim. I spent a lot of time at home by myself as a child. That was on reruns all the time.
Yeah.
But the thing is that this word stagflation, how do we define it? One, and are we on the precipice of that right now with this tariff talk, with this at least inflationary impulse, and it's going to hinder growth?
I think stagflation, because I lived through the Carter debacle. I think it really is defined by an uncomfortably high unemployment rate simultaneous with elevated inflation rate.
With the misery index, right?
Yeah, misery index. Yeah. And the misery index, thanks to the U3 unemployment rate being at 4.1 or 4.2, isn't very high. Never even got to Carter-esque levels, even when the CPI got to 9.1, because inflation, unemployment was even lower. So, but the stagflation thing is interesting because we've just had the Federal Reserve downgrade their expectations for real GDP and upgrade their expectations for inflation. Now that doesn't take us anywhere near the misery index levels, on that, but if you look at the University of Michigan expected inflation number for the past 1 year, it has just gone totally vertical.
But it's all Democrats. That's what they tell us, right?
Well, Democrats
are too.
Independents are kind of in the same thing. But
right.
I understand what you're saying. It could be that they're acting out or something like that. But there's other surveys that show elevated, and Powell liked to pivot to, well, longer-term inflation expectations are not really changing much, so they're not elevated, but they are moving up. Jay Powell went to such machinations to defend that we've got inflation under control because he went to one of the most obscure, for the layman, obscure things, the inflation rate, the 5-year forward inflation rate 5 years from now. They call it the 5-year forward, which, of course, isn't even a thing.
Right.
It's not even a thing. I mean, who has any idea what inflation's going to be starting from 2030 to 2035? Forecasting it today, it's like it's like saying you're going to predict the weather for 87 days from now with pinpoint accuracy. It's just ridiculous. So he's really had a hard time. I mean, he was so happy and so relaxed in January. We're in a good place, in a really good place. Everything's fine, and then all of a sudden they've had to increase their unemployment rate expectations and increase their inflation expectations. So their dual mandate has gotten from we're in a really good place where we got this to now we've got the dock and the canoe problem. So he's got one foot on the dock. That's him trying to deal with what he thinks is a rising employment rate. And he's got the other foot in the canoe, and that's him wanting to cut because he wants to cut for the unemployment rate. He wants to hike for the inflation thing, and he's drifting away. And you're going to get wet.
Right. The Fed has to your 5-year. I always joke the Fed has like 20 measures of expected inflation. What does the world think the inflation rate's going to be? And 17 of them say that there's like a problem to a minor problem, and like 3 of them don't. It's good. Those 3 are the ones that matter, And that's kind of they started with their conclusion that there isn't an inflation problem, and they found the 3, and one of them is the 5-year forward.
Just think, Jim, over the span of our careers, how many inflation looks and indices have been born. It used to be you had the CPI. Mm-hmm. And then it was, we've had an oil crisis, so we can't really control that. So that's just one exogenous shock thing. So we'll do CPI X energy. And then there was food inflation. So we decided, Fed can't really control the weather. So it's going to be CPI X food energy, which became called core. And then people started to talk about super core more recently, where we've tried to take out food and energy and shelter, housing, which that ship has sailed a long time.
That's a Powell invention too.
Yeah, it lasted about 3 months.
Because it gave them an inconvenient answer. I can also remember Yellen went to Jackson Hole, gave this big speech about labor market conditions being very favorable, that the Fed's got the right policy, and they created this index called the Labor Market Conditions Index. See, everything's going fine. About 18 months later, this Labor Market Conditions Index was like flashing yellow and red light that we had problems with. So what did the Fed do? They stopped updating it.
Yeah, when they started to maybe think about easing, they started to lean on something that I'd never seen before, and that's also been downplayed more recently, but they started taking very short-term time periods and annualizing them, because this was in the fall of
the 3 month,
23,
6 month.
The 3 month annualized, the 6 month annualized, and all this stuff. And then, of course, that kind of backfired on them.
Right.
It's just they're grasping at all of these inflation measures, and you'd think it would be probably more sensible to be a little bit more systematic.
But what gives on all this? We're talking about redefining things to make it comfortable. Does the Fed cut? What happens here in this stage? Yeah.
So going back to the stagflation argument, which is weak growth and high inflation, and you'd mentioned you think in the next recession that rates go up. I've been in that camp for a while now, that the risk is that rates go higher, because as we sink into some kind of recession, if you look at the general level, like I said, 3 of these measures say that we don't have an inflation problem, but 14 of them do. There really is an evidence out there that the inflation rate is bottoming way above the Fed's 2% target and might start drifting up. As I like to say, not 8, 10 or Zimbabwe inflation, but 3-ish, 4-ish inflation, which would then keep upward pressure on interest rates. And this is, maybe I'm being accused of being a little bit too online with social media and stuff like that. Everybody's like, don't worry about the next recession, Fed will cut rates to 0, and they can print money again, and they'll goose the economy to keep it from going into recession. That worked in 2010 to 2022, or maybe 2020 to be more accurate, because we never had inflation. We could never get it above 2%. But if we're going to start at like a 3-ish% world and start cutting rates like crazy and hinting at printing money because the economy's turning lower, then long-term rates will go up. I interpreted last fall, in September, when the Fed started cutting rates and long-term rates went up. By the way, my take on that was the Fed panicked because we got 2 data points. At that point, the so-called SOM rule triggered a recession was coming. That was that the unemployment rate was going up too fast. And then we got this massive revision to the QEW revision to the payroll report, which showed that we lost 800,000 jobs. And they panicked that, oh my God, maybe the labor market's falling apart. And their panic was, we'll look bad because we're holding the funds rate at 5. So quick cut at 50. And the minute they did that, the market said, wait a minute, we're still not sure we've solved this inflation problem. And if you're going to start getting easier, 10-year notes started going straight up on a Fed cut, which I think really surprised them. And that's why I think that in this environment, if the economy weakens, unless it is unmistakable that inflation is done and there's data that shows that it is done, if they start cutting rates because the economy is weakening with inflation, long-term rates will go up. And that's the risk I think we have right now.
You may be the only person that agrees with me on this because most people just say, you're out of your mind. We all know that in a recession rates go down. And I say, except for one thing, your career has been informed of nothing but, until recent few years, secularly declining interest rates. They've informed everything. So you had, rates go from 15% on longer-term treasuries, and they went down to 0.5% for a brief moment on it. And every time that things would start to get softened up, you had the traditional response by the Fed, and you also have there's many other things that you have to think about with this. The junk bond market has only been around during broadly falling interest rates until recently, and during broadly falling interest rates, when companies start to have financial stress, historically interest rates have been coming down. Now, yes, the spreads that they have to pay go up, because investors get more worried about default. But when you go from 15 down to 1, the spread can, the spread is volatile and widens at times, but they can refinance in certain cases instead of defaulting. They won't be able to refinance if 10-year rates are going up in a recession. They'll be experiencing financial distress during a time period where they can't refinance, which means they don't have that option, which means they have to default. And so
the fear we saw that fear back in 21, right? When they were offering bonds out, you're saying if we have this rising rate environment, it's gonna be a massive default problem.
Yeah.
But they did issue them. They were like 650 over, but they were 650 over like a 1 rate. Right. And now they've been able to refi in the last year or so because of the fervor for credit, right? Spreads gotten tight. So even though you have a 4 handle, the coupon's still 7, right? So they've got another life in this one last time.
We're in a moment of the commentary that you hear that's a little bit disturbing, because I've seen this several times before, and starts out with the stock market drops 10%. And it's always because of the ones that went up the most go down the most. And so you always have that. But you hear, well, it is painful, but I'm not really worried about it because credit spreads remain very well behaved. And that was true when the stock market peaked out. For the first few weeks, the bond market was doing just fine. The credit markets were selling as anything they wanted to, was oversubscribed. There were moments where there were deals put together that were oversubscribed 12 times, and then it went down to 3 times. And now it's kind of not oversubscribed. Now there's sort of, can we find buyers for these securities? And quietly, the extra interest that corporations have to pay versus treasuries in the junk bond market has been going up. And it went up by 8 basis points. That was its well-behaved. Then it was 30 basis points, and it's still, it's just because treasuries are rallying. It's not because people are worried about credit. It's because, there's a treasury bid or a safe haven bid even potentially. Well, that spread has quietly gone out to about 100 basis points. And in my experience, once you have a 100 basis point move, it's not likely to be the end. It's probably the beginning. If we take a look at my favorite indicator about credit spreads, is just focusing on the junk bond market and comparing CCC, the junkiest junk bonds, the lowest rated, to BB, which are the highest rated. And that spread is a very good canary in the coal mine. And if that is staying at a compressed level, and it was very compressed, not the tightest in history, but it was quite compressed in recent months. That starts to widen, and that's a real sign that the junk market, the credit markets are sussing something out. And I don't really believe, not the S&P 500 is below its 200-day moving average and kind of staying there. I think it's going to stay below its 200-day moving average for a while. And that 200-day moving average isn't moving all that much, but it'll start moving. The other thing that's interesting is the 10-year Treasury has been in a range in recent years of I think the low is 3.6 and the high was 4.8 120 basis point range. Right now, we're right on the 200-day moving average again, although after the last couple of days, we're probably a little bit below it again. So it's kind of interesting that we're right on the 200, and yet stocks have had quite a bit of volatility.
So Jim, can I add that and get your opinion, because you've written a lot, and I know the people in the room, someone's going to ask the question. We have to talk about private credit, right? And so I'm thinking about what Jeffrey's talking about here on the triple C names, the weakness we've seen there. Isn't the bid coming for those assets in private credit? Now, granted, it may be an expressed exchange or something to get there. What's your take on the private credit markets and how you're thinking through them? And what indications are you seeing from the public markets that should be something that our investors should think about on the private side?
Yeah, I was actually going to bring that up. So great question.
Well, there we go. See, I don't even need to be here. I told you. One question, I'll be out.
Private credit. Let's just start with my take on private credit. Is it's I used the word before, a regulatory arbitrage. That following the financial crisis, we passed Dodd-Frank, and every bank has tens of thousands of pages of regulation that they have to adhere to. My favorite statistic from Jamie Dimon is every single day, JP Morgan offices worldwide offer a desk or an office for a regulator that just regulates them. Over 1,000 desks that they have. So 1,000 people go to work every day, and their only job is to regulate JP Morgan. Now, Apollo is big into private credit. How many people go to work at an Apollo office every day regulating Apollo's private credit business? I would say zero. And so their cost basis at Apollo versus JP Morgan is way skewed. And that's why they're coming in with much lower rates, much advantageous terms. And private credit has worked because you can go to the best credits first. I could beat whatever JP Morgan is offering you. And so you don't have to take a lot of credit risk. But now everybody's jumping in those best credits. Now you got to go to the second best credit and the third best credit. And that's where they wind up going. So that's what private credit is. And Dimon has said it well. It's either here's the Dodd-Frank regulations, either hand it to Apollo and tell them they got to follow these rules too, or get rid of them for me, is basically what his argument is. And he would prefer you got rid of them for him. But with this amount of regulations, he could never compete with Apollo when it comes to private credit. But if I throw that in with private equity, the other side of the equation, my concern is a market structure concern. And it's the CoreWeave IPO that we saw. What is an IPO in 2025? It's exit liquidity is really what it is. Why does a company like CoreWeave come public? Because they think that they've wrung out all the valuation and they want to stick it on everybody else. Here, you buy it at the inflated price because we don't think there's much more juice left in it.
Except Newsmax, of course, right? Yeah, there's a lot of juice to squeeze out of that one still. Right?
Right. And so you've got all these private credits out there, and you've got all these private equity valuations out there. And at the first stage of the struggling market, they'll do the Russ Swanson thing. The guy kind of pioneered this at Yale University. Oh, our marks are unchanged. Your public marks are down.
Right.
We're better. And then one quarter out there, down 30 or 40% on everything to catch up, and then they have a crisis on their hands.
That is such a good point. The private equity and now private credit have always been touted in part on a bogus sharp ratio argument. Mm-hmm. They say that there's so little volatility compared to public markets. I was actually saw somebody that was giving a talk largely on private credit. They were from a private credit firm, and their sales pitch was it allows you to wait out the volatility in the public markets, which is just that's just the most mythological idea I could possibly imagine. And the other piece of the sales pitch was last 5-year returns. Great. It's got the highest 5-year return of these various credit comparisons. What a great reason to buy something. It's up the most.
Right.
I've managed money for a long time. On the first portfolios I had, they used and this was not uncommon. One of the most idiotic ways of allocating their money. They had 6 bond managers, all with the same mandate. That was my first account. I was one of them. And at the end of every year, they would take money from number 5 and number 6 in the return rank and give it to number 1 and number 2. And it's obviously an automatic sell low, buy high program. It's like the opposite of dollar cost averaging. It's like let's push as many dollars as we can to whatever is inflated. The other thing about private anything, and private credit certainly falls into this camp, is it really gets into a boom when public markets become analyzably unattractive. And that was really the end of 2021. When if you looked at the stock market, just using the S&P 500, and use all of the traditional valuation measures, just compared to its own history, going back decades. So PE ratio, you could use CAPE ratio, price to sales, price to book. There's all these, there's like 25 or 30 of them you can look at that go back decades. And they were all in the top decile of overvaluation versus their history, and many of them were in the top percentile of overvaluation. And I talked about this in my Just Markets webcast, and everyone thought, here's this bond guy beating up on stocks again. But I threw him a curveball. I said, but as overvalued as this market is versus its historical history, it's actually cheap to bonds, because the 10-year Treasury bond was down at about 1%. And inflation was going up to at least 5%. And so you had this ridiculous negative real interest rate. And so you look at it and say, stocks are not cheap by their own metrics. Bonds are even worse. Rates have to go up. And when rates go up, we know that's going to strain the performance of the stock market. So I can't win with these public markets. And they were right. Right, because the stock market fell 20%, ended up having a better 2022 than the Barclays aggregate market, unbelievably. But they were both down double digits, and so they were right. But the thing is, they just say, okay, let me buy something that I can't map the valuations of public stocks and bonds over to it. So because if I can map it over, then I won't like them either. So it's sort of like, let's see, you're doing a SPAC. Huh, what is that? Oh, it's like a blind pool. So I can't map anything over. So I'll tell you what, I'll give you money for your private credit SPAC or whatever it is under one condition. You don't tell me what you're doing. Because if you tell me what you're doing, I'm gonna hate it, because I'll be able to map stocks and bonds over to it. And that's not so much the case entering 2025. Stocks entered this year very overvalued by that same analysis. Bonds, not as much, but not great, except if you went into like some of the peripheral markets, like CMBS types of securities, some ABS securities, things that are more off the run that we tend to take a lot of advantage of. So that's how you get these booms. And then we actually had a company that wanted to partner with us, because they had this mousetrap where they could give you private equity types of returns using publicly traded vehicles, and that with much lower fees. And they could sort of prove that on a net of fees, you probably do better. And they talk, of course, about the ridiculous Sharpe ratio being bogus, because they just shared up their research with us. Private equity firms, when stocks go down 40%, they mark their stuff down 20%. And then when stocks go back up to the original price, they mark them back up to the original price. So, hey, we had exactly the same return, but we have half the risk. Right. So we have double the Sharpe ratio. No, you don't. You just have illiquidity.
So to give you an example of the Sharpe ratio, I like to say, I've lived in the same house now for 17 years. So the 90-day volatility on my house price is 0. So I'm a brilliant manager, because the Sharpe ratio on the return of my house is like infinity. You wish you could be as good as me. Well, of course you are, because you own a house too and you haven't traded it in 90 days as well. That's kind of what private equity does too. It doesn't trade every day. Now, if my house traded 140 times a day like a stock does or something like that, it would have a different volatility measure.
There's one thing I want to say, because I think it wasn't terribly recently, but it was concerning when you had all these issues going on with protests on prestigious university campuses.
Were they prestigious?
They were. Well, let's start with Harvard, okay? Harvard, which has a $60 billion endowment or something like that. The donations started to dry up because the alums were, not happy with how the response to all sometimes violent protests, and Harvard ran into a liquidity problem. $60 billion endowment, and they were struggling to pay salaries, turn on the lights, pay the janitors. I mean, just basic operations. They had to come to the bond market to borrow money for regular way operations. I think they tried to get $3.5 billion. I think they did get a couple.
They did get it. They did get it.
They got a couple of billion, but it's a scary
It's
situation.
also a muni, I think, because it was qualified tax-free too.
It's a dangerous situation when a $60 billion asset pool can't pay for,
Because it's all private credit and private.
Right. That's
You can't.
right.
You can't
But
see it.
you see it, right? And I raised distressed funds during the global financial crisis. Before it, I just had fantastic experience and results. And I was raising Fund 3, and it was at the absolute perfect time. I mean, it was within months of the absolute low, which you never know when in distressed sort of category of investing, don't know exactly when the low is. It's kind of a rolling low. But I had Stanford University come in, and I was talking to the guy, and I said, "Look, I'm gonna blow your mind. I can prove to you, using basic arithmetic, that the worst case for this fund is probably about 24% IRR." And he said, "How can you prove that?" And I basically said, "Well, these are all residential mortgages, and let's just, I know it's bad, but how many do you think are going to default?" And he'd say, "A lot." And I said, "Well, we're assuming 70% default. Do you think it's going to be 70%? He said, "No, it's not going to be 70%. Okay. And we think the recovery rate is going to be 30 cents. Do you think that's going to be 30 cents? He goes, "It's probably higher than 30 cents. I agree with you. Those are the assumptions that give us 24%. And he said, "Wow, I can't, I hear what you're saying. I can't invest in your fund." And I said, "Why?" He said, "I don't have any money." I said, "Come on, I want your name on a client, Stanford Endowment. 10 million. 10. He says, "I don't have 10 million. I'm defaulting on my private commitments because they're all calling capital at the same time, and I can't fund them." That's when you have private booms. This kind of is the longer term after effect of that, because the liquidity it's fine, if you fool yourself that you've got the superior Sharpe ratio when you don't. But if you need the liquidity, you don't have any choice. And people were selling their commitments. They couldn't make their capital calls. They were selling to distressed, vulture investors they were lucky if they got 75 cents.
So to bring this full circle, in the last 6 months or so in the ETF business, we're starting to get private equity ETFs.
See, that's what I was about to ask, Jim. Now you're asking my question.
Yeah.
Same thing. I was going to say, what the feature that we're talking about here, and it's not the bug, it's the feature, is the illiquidity. Now we're putting them in ETFs. Right.
Which
Are they really private?
deals are getting put into the ETF?
Right. So that's a question, right? And I've made the argument that our clientele is that at the big boom inside of private credit is that we turned it from being a qualified purchaser asset class, right? That, by the way, that definition is very high. That's 5 million liquid. There's not a lot of people that are 5 million liquid. Okay, Jim, Jeffrey, sure. Okay, but a lot of people are not that way. But we turned it into an accredited investor product where it's $200,000 in income over 2 years. Think about the difference in that cohort. And now we figured out if you've got $20 to put in one share of the ETF, you can buy it. Isn't that sound like we're finding ways to change the game, the regulatory environment, and putting it there? But then what you're also introducing is you're removing the feature. You're providing liquidity. So again, I know you've written a lot about it. So
Yeah, you're absolutely right. We're right that large. What we're doing in the ETF space is we're bringing in a whole ton of illiquid non-securities, not only private credit but crypto and everything else that. We're trying to give the illusion of liquidity. Here's something that, I started on this with HYG, right? High yield. In that we're going to give you an ETF and it's going to trade millions of shares a day. It's going to have thousands of trades a day. And so therefore the high yield market is really liquid, right? Because the ETF goes like this. Yeah, but the underlying bonds go like that. They don't move. And so it gives that appearance of liquidity. And when you are in a secular falling environment of rates and the economy's moving, it's all great. It's when things start to turn and get squeezed because you've got higher inflation, higher interest rates, maybe a weakening economy, bring back that stagflation word, then you wind up getting squeezed in a lot of this stuff. And then we'll find out whether or not you have liquidity. Liquidity is a funny thing.
It's a coward. It's not there when you need it.
Right, exactly. It always disappears when you really need it, is really the problem with liquidity.
Never heard of it being called a coward, though. I like that. It's correlation, right? It's never there when you need it as well.
Right.
So we want to open up to questions. Like I said, I figured I would at least get to the list. I've only looked at it once. So, but before we just kind of talk about abstract concepts, let's talk about something investable. What do you guys like today? Give me something that you really like today, Jeffrey. Jim, do the same, and then we'll go around the room and ask about get the audience's questions. So, what's something you like to do today, Jeffrey, that you think people are either underappreciating or don't know enough of?
I'm just going to go back to almost where I started, and that is, I think investors that are dollar-based in particular, that are U.S. domiciled, have tremendous overweights to U.S. investments. And I think that is a big mistake for the prospective several years. So I like the reindustrialization of Europe concept, and I think that should be invested in. I also think nuclear power is going to be very successful as we start to finally realize that we're wasting a lot of resources on energy sources that don't work. And we have an ever-increasing need for electricity and energy. So I like that. And what ties into that is uranium plays. And I don't have any specific names. I don't like doing specific names. And so those are things that I think are interesting. I'm more inclined to like commodities because they've held up pretty well. They were going straight sideways, and now a lot has to do with gold. But gold's like a rocket ship. I don't know if I'd want to invest in it at this moment. But commodities have a very good price behavior. They've been 200-day moving average has bottomed out. The 100-day moving average is above the 200-day. 50 is above the 100. They're all rising, and the index is living. The Bloomberg Commodity Index and the BCOM both living above that moving average. And so commodities are something you don't want to own forever. It's like high yield bonds. You don't want to own them forever. You want to be tactical with them. But those are things that I find interesting. Core investments, I don't like the S&P. I'd rather own equal weighted. I think there's some hope in equal weighted. So these are my themes. Are leaning against all the trends that were mega in place. I think they've all rolled over, and just recently, so it's probably just getting started.
Jim?
I'll answer the question about expectations, and I'll say what I've described going forward for the next several years is we're going to be in a 4, 5, 6 market. And what I mean by that is that over the next several years, cash will return you around 4, because that's about where the funds rate is now. And I don't think the Fed, if they cut maybe one more time, that would be about it. They're not going to be cutting a whole lot because of inflation. Bonds, they'll return you around 5. That's pretty close to the Bloomberg aggregate index yield. It's averaged 4.90 over the last 2 years. And stocks will return you the broad-based indices about 6. So the 4, 5, 6, maybe 6.5 or 7. Now, the reason I start that way is because as a macro guy, people always come to me and say, okay, there's going to be some big asset class somewhere that's going to go up 20%. And by the way, we're talking about domestic, right? So which one is it? It can be stocks, it can be bonds, but something's always going to go up a lot. It's like, how about they don't? How about that they're not disastrous? 4, 5, 6 is not necessarily disastrous, because I earlier said I thought that the inflation rate would be like 3-ish. So, they're giving you a real return. But those salad days of just buy some index, it goes up 20%, I think are behind us. Then in that environment, what Jeff was talking about with, reindustrialization of Europe and commodities and some other things, that stuff starts to work. Because I've used the analogy in the markets that the stock market, the S&P was up 25% last year. It was up 22% the year before. It's like sailing. I know nothing about sailing. But what I do know is if you put me in a sailboat with a 25-knot wind, I just got to get that sail up in the air and the boat moves forward. But if you put me in a boat with a 6-knot wind, now I got to learn to tack and trim, and I got to learn to do some of this other stuff, because that doesn't matter when you have a 20% return in the beta in the index. So, always for the last several years when people say, what should I buy? The answer was, don't waste your time. Just buy the index because it just goes up 20%. And it's hard to make a case healthcare stocks or Europe or whatever it happens to be is going to do better. But now I think that's why I want to talk about expectations. If we're in a 4, 5, 6 environment, it's not a disaster. But now you could start looking at things like uranium stocks and stuff like that. They don't have to be massively high growth potentials in order to provide you a very decent return. It could be something like beaten up financials, which I think is, I've been one that has hated on financials for decades, but now I think in this environment, there's some small regional banks and some other financials that might provide some opportunity. Would I have said that a year ago when the S&P is up in the way 25%? No, not really. But now if it's going to slow down, those types of things can help to provide value. So I think it's about expectations. If you still think the S&P is going to go to 7,000, return 20%, you don't need to waste your time with all this other stuff. Just buy that. But if you think it's going to be 6, then we can start talking about other ideas.
Well, I'd add something to that, and that is that to buy one thing has a lot of risk of failure. In investing, the one thing you don't want to do is take a fatal risk, like crossing the double line. So the double line is actually something we don't do. It's a symbol for risk management. And when I put together portfolios, sometimes it's easy to do this. That's when this business is really fun. And sometimes it's nearly impossible to do this because everything gets to a correlation of 1 and there's nothing cheap. But you want to put together a portfolio where you say, I think this is my view. This is what I think is going to do well and not do well. But then you have to say to yourself, what if I'm wrong? What if I'm wrong? Because you're going to be wrong. I've been wrong about 30% of the time. I've been at this for over 40 years. It's statistically pretty meaningful. And that's a lot. That means I've been wrong for 13 years. Thank God they weren't in a row, because then you're out of business, right? But you're going to be wrong. So you say, let's assume that I'm going to be wrong. Okay, so rates are going to fall in the next recession. They're not going to go up. Okay, so the dollar is going to go up in the next recession. You want to be positioned with clear eyes. You want to look at it and say, I don't know what's going to happen, but there's a range of plausible outcomes. Will one that comes in at the bad end of the range, will it destroy my chance of success? Yes, we'll probably have some underperformance, but got to stay in business. No fatal errors. And so that's a problem people have when they do the things that are overly simple because they seem to be working and maybe they work 2/3 of the time. The problem is that if all your eggs are in one basket, that when it drops 70%, when S&P drops 70%, you're going to panic and sell, and the whole program will be blown up. So it's really important when you're managing other people's money. My viewpoint is you should have a 1.5 to 2 year horizon. Most people that manage other people's money have a 1 to 2 week horizon, and I think that reduces your chances of success. When you're managing your own money, I think you should have a 2-decade horizon, almost regardless of your age until you're I don't know, in your 60s anyway. So time horizon is a big deal, and risk management is a very big deal. That's one of the things about the money management business. If you survive 40 years plus, you kind of become known. And I think people just say,